Welcome back. You're with us here on Halftime Report, and Transport Corporation of India is our next management on the show. It reported a good third quarter. Seaways division continues to drive its profitability. While to discuss this and more, we have Vineet Agarwal, who is the managing director of the company, who is joining us. Vineet, good afternoon. Thank you for joining in. You've given a FY'25 guidance to grow between 10 to 15%. For the first 9 months, you've done 12 in terms of revenue. Which is at the midpoint of your guidance. Do you expect to remain at the midpoint, or by Q4 you would expect that to go to the higher end, which is 15%?
Well, 10 to 15% is a guidance based on some numbers that we forecasted, and things have been quite slow this year. So I think we'll be probably at the mid end of this number itself at 12-13% for the full year also. But the profitability is much better. We had projected a 10 to 15% increase in the bottom line, but we are slightly above that.
Take that point, and a lot of that profitability has been led by the Seaways division, where you've called out that route changes and increased freights, etc., have supported your realizations out here. So the question is how long this is sustainable for, because you've said that Seaways margins on a sustainable basis could be around 28 to 29%. Freight margins around 3% and supply chain margins around 6.5%. We've seen deceleration in both freight and supply chain, whereas Seaways from the 28-29% have moved to around 33%, keeping your overall margins at around 10%, which is pretty much in line with your 10 to 11% sort of guidance. How does the internal of this change, and what's your prognosis here?
Yes, so Seaways, the business has been positively impacted because of the Red Sea crisis, where we know that some ships that were on our sectors that we operate, which is on the west coast from Kandla to Cochin and Tuticorin and Mangalore, that got affected. Some of those ships moved from that sector, and that meant there was a less capacity available, which also meant freight prices went up. And also in the last quarter, actually fuel prices, that is bunker prices, came down. So for us, it was a double positive from the Seaways perspective. On the other businesses, there is a general slowdown, as we already know, in the economy, and that affects both those businesses. Freight is directly linked to GDP growth, and that was slow in the last quarter. As we know, that has had some impact on margins as well. And in supply chain, I think the interesting thing is that we are actually in a very large investment mode. It's like we're creating new facilities for lots of clients. We have a lot of bench strength that we have created for people, and that's in line with the pipeline that we have for the next few months. So very interesting times there, and this is just a temporary blip in terms of margins, but I think it's going to come back very shortly.
You mentioned higher freight rates, Vineet. What is the situation currently? It stands, especially when it comes to the Seaways freight rates, and how is that impacting business?
Well, currently there is enough demand. This is Q4, and Q4 is essentially the best quarter of the year for us. Also, a lot of corporates are closing their books at the end of March, so there is a push towards sales. So there is a high demand, and consequently there are lesser ships. So freight rates are stable, and they're stable, and they're helping us get the clients that we need to move all the cargo that is right now available.
Right. And what about, the cold chain business? How much has that turned out as an overall proportion of your sales in the third quarter of the first 9 months of this year? What's your outlook for this one as we move forward? And also quick commerce. You had said that, you've done well there with the fulfillment of dark stores, etc. This comes in light of some of the other competitors also starting this 2-hour delivery, at least in the cities, for D2C players. So how does the environment look out there in both quick commerce as well as the cold chain business?
Actually, on the quick commerce side, we don't do any deliveries. So we only do the fulfillment. That's the back-end warehousing, because we've realized that the deliveries are really a very low price point kind of business, and really the margin structure there is not very good. So we focus more on the fulfillment side. We run a lot of warehouses for the quick commerce guys, including cold chain warehouses. I think the interesting bit here is that the cold chain warehouses have a separate kind of a delivery system, because when you're delivering from that particular fulfillment center to a dark store and subsequently to a customer, the cold chain has to be precise. I mean, you don't want a melted ice cream to reach the customer. So that is high quality and high frequency deliveries that is happening from these fulfillment centers. So both the cold chain business and the supply chain business, where some of these quick commerce guys have just started to really pan out and go into smaller cities we are seeing a massive growth opportunity. Again, as a percentage of our business, this is going to be quite small. But as a function of how we can change the network design of supply chains, this is a big deal. Because how consumer companies, FMCG companies were servicing other sectors, other channels, this is another new channel that has gotten added.
Right. So, just a quick follow-up before we let you go. You always guide for 10 to 15% revenue growth basis your assumptions and similar growth on the bottom line as well. This time around, you've done better on the bottom line. What's your early prognosis for FY'26 and what is it that the budget can do for you to grow faster than this?
We don't expect anything major from the budget in the sense that there is, for our sector, if there is continued growth in investment into capital infrastructure rather, that will help us because we are a multimodal logistics company. We need those connecting infrastructure of road, rail, sea, air to be integrated together. So that continues, that helps our sector. General GDP growth, EXIM growth, I think those are factors that are going to help us in terms of our growth. I think we are looking at a slightly the softer growth for the first few months of the year, but then post the August, September festival season, we are anticipating a higher growth. So I think, it's just repeating the same, maybe a 10 to 15% on the top line for FY'26, but I do expect the bottom line to be slightly better.
All right, Vineet, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management there of Transport Corporation. Time for a short break. More on the markets and specific stocks on the other side. Stay tuned.